Hi, this is Jason, and welcome back to Red Pill Finance TV. And in this episode, episode 2, I want to talk about central banks' actions and how, in the long term, it could have detrimental impacts, even though in the short term it might come out of good intentions. So, picture this: the majority of your life you work 9 to 5, 9 to 6, from your 20s all the way to your 60s in order to generate income to cover expenses, living costs, and perhaps save up for pension when you do retire. At the same time, of course, you pay taxes. And then comes an economic situation. And the usual response, say, that we've witnessed in the past decade is quantitative easing by central banks and government spending. And essentially, what this is introducing more liquidity into the system, increasing the money supply, or otherwise printing money. So you work the majority of your life, those hours you put in, and the central bank is just able to produce massive amounts of money just with a click of a button. So what is the purpose? What is the meaning of working or even paying taxes when the central bank can, under certain circumstances, do that? And the statistic is in 2020, 20% of the US dollar ever created was created in that year. So 20% in the whole history of the US dollar was just created in 2020, that year alone. That's like saying if you had 100% share of a company and the next day you had 80% share of the company, essentially your share of the pie is reduced by money printing because there's more money out there and you only hold the amount that you hold, and relative to that it becomes smaller, a smaller proportion. That is essentially what is happening, and that is what inflation causes. So over time, say, your £1 or your $1, say 50 years ago, was worth relatively a lot more than it is today, and it could buy a lot more, and the purchasing power was a lot more in the past than it is now. And that is the erosion of value of money through inflation. Now, I think this certain circumstance is different with the COVID situation because it affects all types of businesses, people's income, which is contrasted to the previous one in the financial crisis, where it's mainly due to banks' irresponsible operations and playing around with toxic assets, essentially. So this time round, it is different due to the nature of the pandemic. And it just goes to show that in a debt-based society, so for instance, you get a mortgage to get a house, you borrow loans, you borrow credit for to get a car, tuition fees, etc., etc., credit cards even. So it is a symptom of a debt-based society, which means that in the good times, everything is booming. But in the bad times, when the economy gets hit and unemployment spikes, then you have a lot of liabilities that you can't afford to pay. So that's the issue with a debt-based society. And that's not to say that intentions from central bank is bad, but the way it happens in terms of, for instance, stimulus checks, the requirements to get a stimulus check is very loose, and most people are eligible for stimulus checks. And what this means is, yes, there are people who are struggling who benefit from it, but at the same time, there are a lot of people who have a stable job, they're financially secure, and therefore they're able to, without the stimulus check, be sustainable. But with the stimulus check, it's essentially additional money that they don't need. And quite often they can put that in the stock market or put it into gold or commodities or even Bitcoin. And that's essentially the issue this time round. A blanket check is not sufficient for everyone, or it's not required for everyone. And this probably leads to why the S&P 500 hit all-time high despite it being a recession in 2020. That does not make sense. And that just goes to show that, the rich get richer and the poor just about survive with the stimulus checks. So that goes back to the notion that for people who are financially okay, the stimulus check is just a bonus, and that fuels inflation. And I believe that inflation is there. It's just not reflected in the RPI or CPI index. It's there in different forms. It's there in the stock market because, as mentioned, all-time highs in the S&P 500 does not make sense for a recession. That just does not make sense. So, yeah, that goes. That just reiterates how the risk of inflation might be higher than we actually realize. At the moment, yeah, there's no limit to how much central banks can print. Before, it had to be backed by gold, so each dollar was redeemable for a certain amount of gold. But since that decoupling that happened, it means that really the central bank don't have a limit to how much they can print. They will keep on printing and trying to stimulate the economy. That could even mean negative rates. We do know in certain countries, such as Germany, with certain banks, they're charging negative rates. So they're charging customers to essentially save, which is meant to stimulate them to start spending because you're getting penalized for saving, which does not make sense. So there's only so much a central bank can do with rates. There's only so much response lowering rates can have. But the money supply is there. And once it's flowing in the economy, that's when we'll see a real inflation issue, I believe. So thank you for listening to this episode, and I'll catch you in the next one.